Welcome to my channel. I'm going to show you step-by-step how to value a stock. We will enter the company's financial information and capital structure into my Excel model. Then we determine whether the stock is a buy or a sell. At the end, we calculate and analyze the financial ratios. I am doing this with you throughout the entire video, so it's like we're doing this together. The company we're going to look at today is SKYS Solar Holdings. This is a Hong Kong company that owns and operates solar parks around the world. Let's get started with the model. This company has a market cap of $99.6 million. So that's the value of the company according to the stock market. And they're trading at $4.60. So that's one share of stock. So they're a penny stock. And they're up 46% today. That's why I'm doing this video. Let's look at the free cash flows, because that's how you value a company. You estimate the future free cash flows, then you discount that number back to today's value. And that's what we're doing here. So I'm going to pull the actual free cash flows, which are negative each year. And now we're going to get the net income, which is the profit and loss on the income statement. Let's pull in their revenue. That's the sales for each year. And they're a pretty small company, so it may take them time to become profitable. Let's look at a capital structure. They pay $15.9 million of interest on their debt. Let's see how much debt they have. We'll go to the balance sheet. We'll go to liability section. Current debt of $55 million. That's debt due within 12 months. Long-term debt $148 million. That's debt due after 12 months. They pay a high interest rate, 7.9%. Interest payments are tax deductible, so let's get their effective tax rate. We'll go back to 2016 when they made a profit. Their income before tax is $4.5 million. Their income tax is $1.3 million. So the effective tax rate is 28%. The cost of debt is 5.7%. To get the cost of equity, we need the beta. That's how volatile the stock is. 1.58 beta, so the stock moves about 1.5 times the market. Let's also get their current assets. We need this to calculate the current ratio later. And current assets are on a balance sheet. That's $57 million. And that's $11 million of cash, $4.1 million of net receivables, and $467,000 in inventory. Let's get their current liabilities. That's $90 million. Let's see what that is. Current debt of $55 million, $11 million of payables, $3.8 million of accrued liabilities, $176,000 deferred revenue, and $1.7 million of other. Let's get their stockholders' equity. That's $37 million. That's the value of the company according to the balance sheet. Stockholders' equity is total assets minus total liabilities. That's mostly accumulated other comprehensive income. Let's get their operating income. That's $2.3 million. That's on the income statement. That's how much money the company makes on its everyday operational business. Let's look at the capital structure. The 85% debt. Cost of debt is 5.7%. 15% equity. Cost of equity is 14.5%. And the WACC is 7%. That's a blend of the cost of debt and cost of equity. That's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $435 million. We divide that by 22 million shares. We get an intrinsic stock price of $20. They're trading at $4.60. So they're trading at a discount. So it's a buy according to the model. Simply Wall Street does not have a value for the company since analysts don't cover the stock. I used a really conservative model to come up with this, so it's really difficult to value companies that report a lot of negative numbers. And it looks like the stock was trading, ironically, around $20 a few years back, but it's dropped quite a bit over the years. Let's look at the financial ratios. They have a negative PE, a good price to sales, and a good price to book. PE is stock price over earnings per share. The calculation for earnings per share is net income over shares outstanding. Since they reported negative net income, they have negative PE. Price to sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. I like to see below 2.5, they're at 2.0. So investors are paying $2 for $1 revenue. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. I like to see below 3.5, they're at 2.7. So investors are paying $2.70 for $1 book value. They have a weak current ratio and a bad interest coverage ratio, negative ROE. So current ratio is current assets over current liabilities, so they cannot cover their current liabilities. That's a concern. ROE is net income over equity. They have negative net income, so they have negative ROE. Interest coverage ratio is EBIT, operating income, over interest expense, so they cannot cover their interest expense. That's not good. I calculate this company has a 76% chance of going into default this year. If they don't go into default, they may do well, but they are struggling a bit. Let's compare them to a similar company in the same industry, Algonquin. They're a Canadian company. And in terms of PE, Algonquin has a better PE. SKYS Solar is only winning in price to sales ratio, and they have a little better current ratio, but Algonquin is better in the other categories. Like I said, it's really hard to value small companies that report negative financials. But let me know what you think of the video. Let me know if you have any suggestions. Thanks for watching.